Welcome back to the channel. If you're new here, I'm Jay Duffy, Managing Partner at Frame Wealth Partners, where we help business owners and executives turn complexity into clarity and financial confidence. Before we get started, do me a favor. Subscribe to the channel. It's number one. Smash that like button and hit the notification bell, because nothing says financial discipline like letting YouTube's algorithm remind you to be responsible. All right, let's get into it. This is what I call the executive paycheck illusion. The belief that high income automatically equals control, flexibility, and security. Unfortunately, it doesn't. In fact, equity compensation often creates less control unless it's managed intentionally, which is ironic because on the outside, everything looks fantastic, if you ask me. So how does equity comp really distort reality? Well, equity compensation is powerful, but it's not salary. Salary is predictable, equity is conditional. RSUs vest when the company says so. Options depend on valuation, timing, and whether the market is feeling generous or moody that quarter. Bonuses show up unless they don't. So here's where the illusion forms. Net worth grows faster than cash flow. Taxes don't line up with vesting, and expenses stay very real and very monthly. So on paper, you're wealthy. Congrats. In real life, you're timing dependent, I would say. That's not a failure, that's a planning gap. And it's more common than people admit, because nobody likes saying, yeah, I make a lot of money, I just don't always have it. So the tax surprise engine, what is that? This is usually where the stress shows up. Most executives don't realize they have a tax problem until they have already had it. We see things like RSUs vesting with withholding that sounds reasonable until April. And then equity income stacking on top of bonuses and base pay. That's crucial. State taxes and Medicare surcharges sneaking in quietly, and then options triggering AMT or large ordinary income without liquidity. At that point, people say things like, I thought they withheld enough, which is the financial equivalent of, I thought that was enough sunscreen. The issue isn't taxes, it's lack of modeling. When equity isn't projected in advance, the IRS gets to be in charge of the timing, and they are not known for being flexible. So let's talk about net worth versus liquidity. This is the most misunderstood concept in executive planning. Net worth does not equal flexibility, folks. We routinely meet executives worth millions who hesitate to write a large check, avoid career moves because of unvested equity, delay diversification because the stock will come back, live off of expected future income instead of usable cash. That creates quiet anxiety, if you ask me, the kind you don't post about. The solution isn't selling everything and moving to cash, it's creating rules. So rules like minimum liquidity independent of equity value, systematic sell down strategies, and clear separation between growth assets and life assets. Hope is not a liquidity plan, folks. Rules are. Let's hit on some insurance gaps executives tend to ignore. So equity compensation amplifies risks, but insurance rarely keeps up. Common blind spots are disability coverage capped at base salary, employer life insurance mistaken for planning, no plan for sudden income interruption. Here's the uncomfortable truth. If your lifestyle is built on equity-driven income and your protection is built on base salary, that math just quite frankly doesn't work. Insurance isn't exciting, but neither is discovering gaps when it's too late. Let's hit on some estate and family implications. Illiquid equity creates estate issues long before anyone wants to talk about them. We see forced sales at bad times, valuation disputes, unequal inheritances, liquidity shortages, you name it. Estate planning isn't about death, it's about not creating chaos for the people you care about. Liquidity planning is estate planning, especially for executives. So, in closing, equity compensation isn't the problem. Unmanaged equity is. High income doesn't equal control, folks. Net worth doesn't equal flexibility. The goal is to turn equity from a stressor into a tool, one that supports your life instead of running it. At Frame Wealth Partners, this is exactly what we do. Integrate equity, taxes, investments, insurance, and estate planning into one cohesive strategy, because success shouldn't feel fragile. That's all I got for today. See ya.